Hello everyone, welcome back to Fundrise Finance. The month of November was extremely good for the markets, with the S&P 500 rising almost 8%. In today's video, I want to discuss how my options portfolio performed in the month of November, how I made use of this upward momentum to generate more income. So without any further delay, let's get started. For those who have been following my options videos, you'll be fairly comfortable with this sheet that I use to track my transactions. Even if not, let me just give a quick overview what this sheet is and what all I can track in this. So starting with the stock on which I have the option contracts written, what strategy I'm using, how many contracts, when I opened them, what's the expiry, when did they get closed, how many days rental expiry, after closing, how many days I was in trade for it, and a few trackers like the current price and the percentage, how much is the gap between the strike and the current price, and this section is the amount received in which I have the strike, the action of the contract, how much premium I received, this is for the whole contract, the commissions and fees and final value. Then I have the amount paid section. Likewise, I have the closing action, what's the closing premium paid, what's the fees and what's the commissions and fees, and the final amount paid, and the profit and loss. How much is the capital committed for that transaction? Then yield to strike, that's like how much premium I receive divided by the strike price. If it's close to 1% and I'm able to close successfully, that would be an awesome transaction, and I would love to repeat that more and more. And return on capital, annual return on capital, any comments that I want to capture for that. And finally, some after tax profits, just to keep myself honest. I consider 25% as the tax for each transaction. One other important thing is the suggested sell column, which tells me when I open a contract, how much should I sell it for? I keep myself a 75% profit target. If you go as low as 50%, if you prefer to close it at 90%, in fact, if you even let it expire, I prefer pretty much always to close out my trade at 75% profit unless the strike price is far away from the stock price. I make that call. Otherwise, most of my transactions are closing transactions. So yeah, with that jargon out of the way, let's get started. I had a few trades that were hanging over from the month of October, like the starting one on medical properties, which was supposed to expire on November 17th, but I got it closed at November 6th. This whole transaction yielded just over $8. Then I had one on Bank of America that was supposed to close on November 3rd. Then I had one on Microvision, which was supposed to close on November 10th. I got that closed on November 9th, giving me a little profit of just close to $4. And then start the transactions for stocks, which really started to get to climb higher in the month of November, starting with Verizon, whose contract was supposed to expire on November 3rd at a strike price of $33. But if we look at the chart of Verizon for the month of November, we see it's just goes higher and higher. It has risen more than 8% in 1 month. So I had to roll this transaction, taking an instant loss of $215, marking it as a buy to close roll, and subsequently opening a sell to open. So I marked it as rolled sell to open, RSTO, which I had to roll again until December 22nd. So I really don't know. I have to really manage this trade very well. The current stock price is upwards of 38 bucks and my strike is at 33. So that's what this gap tells me. It's over 16%. I'm really unsure if I can fill that gap up. Hope Verizon takes a dip in December and I'm able to raise my strike price. Somehow I have to manage it accordingly. Likewise, I had Citigroup, which ran away from me. I had a strike price of 41 bucks. And if you look at the chart of Citigroup, we can see in the month of November, it's almost 16.5%. So just like Verizon, I had to roll this transaction, getting to rise my strike price by 50 cents at 41.50. But even that wasn't enough. I had to roll this again. And that's what we see here, an open transaction right now with the contract expiring on December 1st, where my strike price is just over 11% below the current stock price. Just like Verizon, I had to really manage this well. And continuing the sequence of such trades that went against me comes Bank of America, when I had a $28 strike price. And just like Citigroup earlier, even Bank of America in the month of November did really well, almost 15.5% in 1 month. Crazy, crazy rise. So I had to roll it. So this is the roll transaction. Again at 28, I couldn't increase the strike price like I was able to do with Citigroup. And even then, I had to roll it again. And this is my current transaction expiring December 22nd. So these three stocks, that's Verizon, Citigroup, and Bank of America, have really run away from me. I have to manage them very carefully, hoping that they take a dip in the month of December so that I can catch up on the strike price, or else, in the worst case, they get called away from me, which I don't like to see happening. But if it does, it is what it is. After that, I had a small profit on the covered call on a CHD, giving me just over $4 in profit. Likewise, SoFi, almost $8 in profit over here. Then Lucid, just over $5, and SiriusXM, similarly just over $5. From here, basically what I did was seeing that the market is in such a great mood to go up and up, I thought of adding something into my option arsenal in the form of put credit spreads, which are also called as bull put spreads. So basically, for a put credit spread or bull put spread, you expect the underlying stock to be higher than a certain value where you think that there's a strong support. So in this example, let's say a stock would be at least $100 or more. So what we do is we sell a put at that $100 strike and then buy a put at a strike price lower than the earlier short put. So in this example, it's at $95. So as long as the stock remains over that initial level of $100, you're in complete profit. But if it's in between that particular short put and the long put, then your profit keeps decreasing. And if the stock price by the end of expiration is below the long put, then you lose whatever you have wagered for, which in this case is like $500. I'll try to create a detailed video to make it more simple to understand. So that's what I did, starting with SoFi, which gave me a profit of $6, and Chevron, again a profit of $16. So basically, the best part of what could put credit spread over a cash secured put is, let's say for Chevron, right? Which at the time was, I believe, close to like $145 or something. If I had to create a cash secured put, I need to have $14,500 in my account, which is a lot. Instead, if I created a bull put spread using just $100, you see here, the amount committed was just $100, and I received almost $16 on it. Now we don't see the annual return here because I was able to open and close the transactions on the same day, which I didn't wanted to, but it just happened. So you can see after that for AMD, likewise, I opened it on November 15th for an expiry 2 days later, but I closed it by November 16th. Like a days into it was like one. I believe AMD was like around $120 at the time. So for a cash secured put, I would have needed $12,000, which is still a lot. Was able to generate almost $13 using capital of just $100, giving me a return of almost 13%. Every day, if you're able to generate like $13 annually, yes, you can generate 4,000% return, but that's practically not possible. Still, for that moment, it's a good transaction. So after this, I thought rather than raising the spreads on individual stocks, which are far more volatile, why not go for the indices? So I started to create put credit spreads on the S&P 500, the SPY, the Russell 2000, IWM, and the triple Qs. Now SPY and Qs have options opening and closing every day. IWM has every 3 days, the Monday, Wednesday, and Friday. You can open and close. There are lots of contracts that are traded. So it gives you much more flexibility over there, unlike individual stocks, which are weekly. So if you see here, I did a put credit spread on SPY for consecutive days, netting me almost like $25, all on the same capital of $100. Likewise, I had one on IWM closed for a profit of $9. Of course, the triple Qs gave me a rude shock where I lost $23. Now, option trading is never risk-free, but such incidents teach you something. If once you get to learn those mistakes, not do them again, you should be good. I have a few more open that expire on December 1st. You can see here SPY, likewise QQs, and the IWM. So yeah, they have been pretty a good put credit spreads that work for me. Other than this, I had pretty much covered calls on Lucid, Sirius, SoFi that eked out small gains of close to 3, 5, and $7. So coming to the overall value for the month of November, I made almost $234 on a capital of $16,435, of which close to $11,000 were stuck in my Verizon, Bank of America, and Citigroup. So I would say almost 90% of the returns came from $4,000 or $5,000 that were actively working for me. The put trade spreads just demanded $100 into each of the indices. So I would say maybe three or $400 is what I used over there and generated enough to give me a return of 1.42%. My target is to reach 1% every month, and I made much more than that. So pretty happy for the put trade spreads to actually save the month for me. Looking at the premium chart, we can see the bar that started in March went higher and higher in June. Then, like a roller coaster, we had a steep fall, and then again we are here seeing the bars go higher again. Now, the return growth would give a much simpler picture to look at. You can see here the return of 5.15% for the June. That was like freaky month. Not sure if I'll be able to do that or get such returns again, but you never know. After that, by September, it fell to less than a percent, like 0.82%, and now the lines are going higher. So, hoping to see such a similar high peak in near future. That is really good to hope for. Let's see what we get to do or what we'll see in the markets in the near future. So yeah, that's all I wanted to discuss with you all. Hope you all liked this video, found it valuable. And if so, I would really appreciate if you could hit that like and subscribe buttons so that YouTube will suggest this video to many more people out there. And that would really help this young channel. Until we meet in the next one, let's try to do as much as possible to be financially healthy and keep taking those small strides towards financial freedom. See ya. Bye.